Happy Friday, everyone. You're watching The Hash on CoinDesk TV. We have the whole gang here again. Zach Seward's up there dancing in the corner. We got Will Foxley underneath him, George Kaludis in for Naomi Brockwell, and I'm Jen Sanasi. Zach, you got our first story. Take it away.
All right, let's take it away. Let's talk about Paul Krugman. Paul Krugman is an economist writing in the New York Times and drawing some parallels between the subprime mortgage crisis and the most recent Bitcoin boom. Now, I think the headline is a bit of an oversell on this, and I think Paul Krugman will be the first to recognize that. I saw him on Twitter yesterday, sort of, saying that this isn't as big a chunk of the economy in a way that the subprime mortgage crisis was able to inflict pain during the 2008 financial crisis. So while Bitcoin is still a sliver of the economy, he's seeing some parallels that make him have some pause. Now, I think it boils down to these last couple graphs in his piece, which is thoughtful and interesting piece, but I think it's sort of about the downsides of democratized access to assets such as Bitcoin, Ethereum, and other cryptocurrencies. So a lot of interesting stuff in here. I think I'm not here to run the bash Paul Krugman campaign. I think it's a measured piece. I think it might be a little off base on certain points, but hey, it's a conversation starter. So let's do this thing. Let's start a conversation. Will, what are your thoughts?
Yeah, just to kind of lay the table, I think this piece is interesting. If you take a step back and say, hey, look, crypto is now at the part where central bankers and others are looking at it and saying, we need to have a conversation about if crypto could influence the way that the economy works right now. And that's a pretty momentous occasion. That's not something a lot of people would have thought would have happened a decade ago. So that's like a good kind of checkbox towards hyper-Bitcoinization, or at least cryptocurrency becoming something in everyday life for most people. Moving on to like his argument here and the topic in general, it's really interesting how this article itself kind of lays out the thesis for monetary policy in the United States, right? So if you think of monetary policy in general, it's like this box, and everyone's trying to make sure that their economy works out and there's no leakages in the system, and you're trying to like almost engineer your economy. That's a lot of what central banks do when they pump up interest rates, or they try to drop asset prices or increase the velocity of money within an economy. And crypto is kind of a leakage in that boat, right? You see stable coins, there's hundreds of billions of dollars of stable coins now. Why are they there? What are they doing? Well, even more important for a lot of economists is saying, this is a leakage in the system that we have not confronted before, and we need to start having a conversation about what stablecoins will do. And then there's the conversation, which is even more important, about Bitcoin, and Bitcoin being this new reserve asset. That's obviously a conversation a lot of people are having on Bitcoin Twitter, and it seems like it could be a conversation going forward as we see a lot of states be interested in getting off a dollar standard and move to something else, whether it be a currency for themselves or a currency for an internet age. I'm actually going to throw this up to George if I can, because I'm really curious to get your thoughts.
Yeah. Is there a super brave Austrian economist out there that can go toe-to-toe with Paul Krugman? Because I'm certainly not one of those people. I admit that he is an economist, a trained economist, and Loma Lord at that. So I'm not going to go toe-to-toe with him. But I think this piece in particular, I'm going to cherry pick stuff because that's what I'm allowed to do now since he's not on the other side to argue with me. I think it's really odd that he says that people in El Salvador are having to pay high transaction fees. I'm pretty sure that's empirically false. You guys can correct me if that is not, but I'm pretty sure they're using a Lightning network, and if you use Lightning, it's really cheap right now. So I don't know where that really is coming from. He also says something that really kind of blew my mind. Well, okay, that's maybe an over-exaggeration. He's talking about the uncomfortable parallels of the subprime crisis, which is like kind of what made Bitcoin come to be. Maybe not even kind of. It's like actually what made Bitcoin to be. So it's sort of weird that he says, I see the uncomfortable parallels. It's like, well, yeah, duh, that's what this came from. What are you talking about? Like, of course there are parallels, right? And people are going to keep trying to rebuild the same old system, even on top of Bitcoin. So again, that's my like maxi take on it, where, Bitcoin's not the problem here. Maybe crypto's the problem. Jen, did your hand go up? Did I see that? Or
It did. Yeah. I am also happy that he's not here for me to go toe to toe with. I took issue with this small piece I'm going to cherry pick as well, George, from the article where he drew on research that said a report found that 44% of crypto investors are non-white and 55% don't have a college degree. He says this matches up with anecdotal evidence that crypto investing has become remarkably popular among minority groups and the working class. And so he does speak to this later in the article. He says that he acknowledges that these people are often forgotten by the traditional financial system. But I think if we zoom out, right, and we don't think that the US represents the entire world, and we think about countries where, people aren't able to get an education, there are women who are oppressed, who aren't able to go to college, and there are people who, have to drop out of high school to support their families. Crypto, I think, serves these people much better than the traditional financial system. And I don't think that this was really unpacked in the article. And while saying that, I really wish that he would have, maybe brought some quotes in from the rich elite who have supported crypto and Bitcoin in the past. And those quotes didn't make it into this opinion piece. So that's what I was a little saddened about. But I'll pass it back up to you, Zach.
Yeah, it definitely calls for more protections. The protector meme came to mind there, where we need these elites to protect the poor people from access to financial freedom, which was a bit striking to see in this piece. That was definitely sort of the closing sentiment. So that's my closing sentiment. We're going to change gears. We're going to give it to George. What's up, George?
And before our intro, Jen, the people now who are unbanked and underbanked are unbanked and underbanked from the current system. So we need something new. Anyway, my story is about another big bank. Goldman Sachs came out and they said that Bitcoin, altcoins, to become more correlated with traditional financial market variables. I think I'm feeling very loose today because I'm going to say that, well, duh, of course, this is going to happen, right? So
did we lose George?
We lost George.
Frozen. Oh,
I like his freezing face, though. Look at him. He's just quizzical.
He's
just
forever skeptical.
Forever
it
frozen.
Wasn't he.
You never know. It's like
concern.
Yeah, I did not expect you to still be here. It's Russian roulette whenever your screen freezes, though, because are you going to look ugly and weird and have a strange face, or are you going to be okay, it's not terrible.
All right, let's talk about the story. I think we've been seeing this play out certainly over the last few weeks, right? Bitcoin is behaving more like an asset that is correlated to other assets. And I think there had been thoughts early on in crypto's emergence that, hey, maybe this is like a non-correlated asset. Maybe it acts independent of the factors that, make the market rise and fall. But I think we're seeing increasingly that it's becoming, more and more mirrored to equities, right? When the equities tanked, so too did Bitcoin. So that this is being highlighted by Goldman in this report is a bit of a, as George was saying, we get it. Yep, cool, Captain Obvious there. But it is interesting to see this emerge, and I think it's interesting to sort of be. I think there's more momentum around Bitcoin not being non-correlated to other stuff in the market and other stuff in the world, and this is another data point that I think supports that. But George, welcome back. You're unfrozen. And we're very curious about your opinions.
Not sure what happened there. I'm sure you guys said a lot of the same things I was going to say. But this is a classic case of the banks or a banker or an investment banker seeing, something that is empirically happening and saying, ooh, let me get in front of this super obvious thing that's going to happen so I can look smart for my clients, right? We have empirically seen, and I don't know if you guys have the graphic, but I was looking at correlations this morning. So cue the graphic. Hopefully someone can pull it up. We have seen, perfect, wonderful. Since July, we've seen S&P's correlation to Bitcoin tick up a little bit. Now I'm going to throw a lot of caveats in there. What in the world does correlation mean? So when you say correlation in the real world, correlation can mean two things to people. Correlation can mean, okay, what is correlation? I don't know what you're talking about. That means nothing to me. Or you think, oh my God, if S&P goes up 10%, so is my Bitcoin, or vice versa. In reality, that's not really what happens. You can see on this chart, 0.2 correlation means that it's from a mathematical perspective, and I say this as a math undergrad, they're not really correlated, right? They're kind of loosely, weakly, not really at all correlated. So while people say correlation, it's kind of weak. But really, the reason that a lot of people in the space have kind of said this is coming for a while is because once institutions come in, they're going to put dollars and cents to work, right? They're going to buy stocks. They're going to buy, the GameStops, or they're going to probably buy something else, maybe Lowe's stock. I don't know. But they're going to buy Bitcoin too. And then as those stocks tick down, they're going to say, oh my goodness, risky assets or things that we view as risky are going down. We need to sell all our risky stuff and become less risky. So as much as we want all of these institutions to see their money in sats or see it in GWei or GWei or whatever it's called in Ethereum or your favorite cryptocurrency, they're not looking at it like that, right? They still see dollars and cents, and they have quarterly meetings with their investors. They have annual meetings with their investors. So they don't want to lose their money. And they're actually not as convicted as probably everyone on this call is when it comes down to, this panel or whatever you want to call it. Dollars and cents still rule the world, and returns are measured in dollars and cents, not in sats. Anyway, I'm sure you guys said a lot of that.
I have no conviction. I have absolutely no conviction. I sold everything last week down very bad. Now, the thing that was interesting to me and this goes with all the banking reports that are out there, they always kind of take the low hanging fruit and then run with it as a report. And it's like, okay, like we know that Bitcoin and altcoins are correlated with tech stocks. Like that has been something we've seen all of last year. And even 2020, let's go back, rewind the clock, March 2020, we saw Bitcoin drop like a rock, hit really hard down to 3K levels and then bounce back up. And what did it track all the way through 2020? Tech stocks and basically the S&P 500. It followed along with it. So it's funny how they kind of cherry pick this and say, oh, when Bitcoin went down, when tech stocks went down, and when other commodity or stocks and securities went down. It's like it also went up at the same time. And like, I guess you don't need it to prove it both ways. If one goes up and goes down, and maybe that's how you make a report in banking. But across the board, it just doesn't seem like this is necessarily something that you needed to like point out. Most people kind of know it at this point. Zach, I am interested to get your thought. Maybe you have a little more nuanced take on this. To me, it just seems like another banking report that is irrelevant.
No, I got nothing. I mean, I think it's like the institutions are here, right? The institutional Bitcoin herd, and it was going to be this great big thing. And it largely has been a great big thing, but it means that, as George was saying, this is the flip side of that coin, right? Institutional Bitcoin adoption means that Bitcoin behaves more similarly to other institutional assets. And I think this has been manifesting itself over the last year for sure. And as that handy chart that George brought out, I think some of the data supports that. But George, last thoughts.
Last thought. You can also make the numbers say what you want them to say. I actually saw Alex Thorne from Galaxy Digital throw up a 40-day correlation chart to, I think, tech stocks, and it was incredibly correlated to Bitcoin. So numbers can lie sometimes, depending on how you show them. You just got to put a lot more context around them. So to the defense of Goldman, maybe they were looking at 40-day correlations, maybe not 90 like I do. So,
all right. Well, let's talk about some other stuff. We're going to take a break, and then when we get back from the break, we're going to ask you if you are ready to flip some burgers, fry some fries, because there's a new DAO in town that's called FriesDAO. And they want to buy maybe a Wendy's near you. Stick with us. We'll talk about it on the hash after the break. Thanks.
You can NFT anything that is inspiring to you.
This space has changed my life.
And then I started looking under the hood. I like the potential and the freedom that the NFT world gives you.
I want to be with the forerunners that are pushing the change to how not just musicians, but how creatives are going to sustain themselves.
In the non-fungible joking show, if this ends up being huge, it would change the world.
Hello and welcome. CoinDesk TV has a lot of cool shows popping up. That NFT All Stars looks really cool. But
That's
welcome
right
back to the hash, everyone. Yeah, right? I should just hop on over. Anyways, it's Friday. We're talking about fries and McDonald's and Wendy's and all of the fabulous junk food that is bad for us. So FriesDAO, a new DAO, wants to crowdfund the next fast food franchise. The FriesDAO group is starting a $9.69 million fundraising drive where benefactors will receive voting rights over which fast food chain the DAO buys. Now, while members have the voting rights that influence the decision on the acquisition of the restaurant, they will not have ownership rights, a stake in its profit, or final say in the business. So, Zach, I'm going to toss this over to you because the last time we spoke about DAOs, I asked you a question and then I froze and was deplatformed and was gone and I never heard your answer. And you were talking about the decentralized and the autonomous part of DAOs, which I think is the crux of this story, right? People are holding this token. They don't actually get any part of the business, but it all comes down to the regulation and the decentralized autonomousness of it all. So take it away. Tell me what you think of this story and maybe touch on what you were saying in that segment, which I was kicked out of.
Okay. Well, first of all, those fries look really tasty. I got to say that. So shout out to the fries in that photo. Looking delicious. It's delicious as always. All right. Second of all, yeah, I think with this emergence of DAOs, we're going to see this like tricky and kind of awkward dance around the ideals of decentralized governance butting heads with the reality of securities laws in the US especially. And I think what is happening here in FriesDAO is they're trying to kind of thread the needle to make this work in some way because, hey, it's one of these funny, audacious, kind of cool goals that people on the internet can rally their funds and their energy behind to make happen. But you also don't want to be seen as issuing a security because that comes with certain ramifications that may be unpleasant to most folks. So this, to me, is, again, one of these tension stories that we're seeing. I think people are sort of captivated by the idea of what a DAO can do and can be. This, really came to a head with the Constitution DAO saga that was on national headlines everywhere. Oh, we can do this. Friends on the internet with the shared bank account can buy a national treasure. We're seeing these experiments with golf courses and now with fast food. But it's still sort of murky, undefined legal territory. So everyone is treading very cautiously here. We talked about Lynx DAO. They rolled out their NFTs. They were going to roll out a governance token. They ultimately shelved those plans to roll out a governance token because there were those unresolved legal questions that could put these projects in hot water with US regulators. So, this is interesting to see. It would be cool to see these things just live in the wild unimpeded, but that's not the reality we live in. So, these considerations have to be made. And I think, this piece really articulates some of the considerations that this project is making. So, yeah. Fries. Will, fries.
I'll pick it up. I'll pick up the fries. I can't eat anything at fast food restaurants because I'm very gluten-free, but it was interesting to see the story nonetheless. This brought me to 2 points. If you know Joseph DeLong, he is a former CTO of SushiSwap, which is a DAO focused on building the SushiSwap exchange, which is basically an exchange for tokens, just like Coinbase, but it's all automated and on-chain. He left the project pretty recently, and the reason for leaving the project from his tweets and from the reporting I've seen has basically come down to the fact that it's very, very, very difficult to engineer and run a DAO. Almost impossible. It's impossible to coordinate all these things. A lot of times it's because the incentives aren't there. In order to get funds for your team to incentivize them to build better code, you need money. To get that money, you have to ask for it from a treasury. The treasury is controlled by a bunch of people who are holding that token, and they don't want to see it liquidated. So basically, the incentives are aligned. And you look at this McDonald's story, I kind of see the same thing, right? There's no incentives aligned for the people who are getting into this, besides kind of sticking with the meme. So it's almost like the Constitution story redux, right? We have the same thing. People who are involved with it have governance tokens that are totally meaningless besides being a part of it. And if that's what you want to do, that's totally fun. Go have fun with it. I think that's something about crypto that's really interesting is you can just dump a bunch of money to be in a meme project and, be a part of a community. And even the Discord, Danny kind of put that in the bottom of the story. There's 5,000 members of the Discord. They're all Shift members. There's some Shift managers. There's Boss, the manager of the FriesDAO. Pretty fun thing to be a part of. And I've been in those group chats in the past. They're really, really fun. It's almost like when you purchase that token, you're paying for a comedy night or you're paying for events, Elages or Six Flags or something like that. that's what it kind of comes down to for me. And no, like you're not going to get money out of this at all. Securities laws, they'll just stamp you out pretty quickly, and nobody wants to go to jail over what amounts to a meme. Jen, I want to throw this over to you though. I like these kind of stories more than the cringy metaverse things we've been seeing from like Warner Brothers and others.
Well, you're welcome then for covering this story on a Friday. I'm happy I could send you off into the weekend with a smile on your face. I just wonder though, the people who are joining these DAOs and joining these Discords, like, are they actually active in the Discords? I've said this on the show before. There's 5,000 people in there. I would love to see how many people are actually active and contributing to this conversation. I don't think I don't think the ratio justifies what we're. Yeah.
You've been they always just say the same thing. When token, when rebase, when pump, when to buy. It's just the same phrases over and over again.
I know. George, what do you think of this? Like, do people understand what they're getting into when they're getting into DAOs? And is this just like a really early way to prove out these governance tokens, and we just have a long way to go on this roadmap?
Yeah, I don't mean to sound paternalistic, but I don't think they do know, because when I read this, I thought that you actually had an ownership stake in whatever fast food franchise that they were buying. I was actually completely unaware that they have no stake in the cash flows. That I was super excited about this because I thought, people were getting together, people who are unaccredited investors, and they're able to buy something like cash flowing business or potentially cash flowing business to, build their wealth in a time when it's difficult to build wealth. And I don't know. I got rug pulled by Jen because she said that they don't get any money. That's stupid. I mean,
I'm so sorry.
I don't really have a better word than that. I guess, the SEC is the paternalistic one here, because securities law is securities law because they say so, not because they're necessarily protecting us. Protect us from making money. Oh, no. Again, not saying you should invest in FriesDAO, but I should be able to, buy a fast food franchise with 5,000 of my best friends if we raise the funds.
That's a great line. Okay, let's move over to... Sorry, what'd you say?
No,
nothing. Nothing.
Continue.
Okay.
Yeah, nothing.
You know what?
Great
we'll
joke,
leave
Jen.
it there.
Thank
We will leave FriesDAO in the rearview mirror. I'm sure we'll come upon it in open country soon enough. So let's talk about Bitcoin mining. A group of Democratic lawmakers led by U.S. Senator Elizabeth Warren have been asking details from a bunch of public Bitcoin miners on the consumption of electricity and if they're raising electrical costs in the regions that they operate. Notably, these letters were sent to Riot Blockchain and Marathon, which are some of the largest public Bitcoin miners out there, very large firms. Essentially, they just want to know, hey, is there validity to this argument that you guys are, one, raising costs of electricity for local people, and two, are you guys contributing to climate change by using so much energy? We've seen Elizabeth Warren kind of be beating this drum for quite a while now. She's been in congressional hearings, or in Senate hearings rather, multiple times over and over, grilling people on if this is the case. She doesn't seem to be hearing all the shills on Bitcoin Twitter saying that she is misinformed. Somehow it doesn't really get to her. But, actually, I'm just going to throw it up to Zach. I want to get your hot take on this. Why does it seem like we can't get any of the information across to some partisan people in the Senate or on Capitol Hill in general? And do you think that there's any validity to her take here and the inquiries that they're giving to these public firms?
My hot take is that Bitcoin mining firms should be doing this. I think if making these reports as easily accessible as possible will make it better for the Bitcoin mining industry as a whole, right? It makes it so that they're not seen as hiding something, some dark, environmental, dirty secret. They need to be out here, I think, working on these dashboards that show what power they're consuming, from where, and I think that data will be beneficial to the entire industry. This remains like the thing that people keep discovering over and over again. And I think it's time that, especially as mining has moved to North America in the wake of the Chinese crackdown earlier this year, I think it's time for these firms to make these data dashboards available. I don't think it's going to hurt their argument. I think it's just going to potentially buy goodwill when it comes to how this sector is regulated going forward. So yeah, they should get on that. They should be like, okay, yeah, here's our energy dashboard. Boom, there it is, done. That's it. Those are the numbers. Run with it. I think that's what they should be moving toward, and I think it's something that could be done. We saw like Filecoin, which is a blockchain protocol. They rolled out this like Filecoin Green dashboard that's open source, could be integrated by blockchain, by Bitcoin miners and other firms. I think it's something that would be cool to have more transparency around, right? Blockchain is predicated on data transparency, and I think that same ethos could and should apply to energy consumption as it relates to proof of work mining. That's my thought, but I saw Jen's hand up.
That was a good hot take.
That was a great hot take, Zach. I have a question for Will. Will, you have explained this on the show before, but it's still like not completely sinking into my head. And so I feel like maybe the audience also feels that way. So in the article, Stronghold responded in an email saying that they use coal refuse to generate power and mine Bitcoin, which actually helps solve the environmental problem and stabilizes the grid. Just explain to me again how the coal refuse process works.
Oh, big question for somebody who doesn't understand it. But I can tell you what I do understand from someone who's explained it to me. Essentially, when we're looking at different types of energy sources, like there's tons, right? You have hydro, you have solar, you have coal, you have oil. And coal often, when you burn it for the first time, it leaves a lot of refuse along with it, like old coal that has been burned and it's just kind of sitting there in slag piles. You can re-burn it again using some new technology and not only pull out more energy from that basically used coal already, but then when you do so, you get rid of the slag pile as well. And that kind of destroys all the energy concerned along with it. I'm sure there are some that someone who's a little bit more nuanced and informed on the subject can tell you about. But from my understanding, the way it's been explained to me is you get rid of these giant piles of old coal that's already been burned, and then it's not an eyesore in the environment. And then also, you don't have the water runoff problems that are associated with these old coal piles. And I think there's also some like greenhouse gas emissions that are cut down by reusing the coal again. So I think like around the board, it's been kind of seen as like a very beneficial way of using energy, not just for Bitcoin mining, but in general. And I think Zach's state, good old Pennsylvania, classifies it as one of the greener types of technologies that are available today. There you go. Was that pretty good? Was that better or was that worse?
That was good.
Okay, so it was like a C+.
No one else thinks it was good. That's like
C+.
Not good from one out of three people.
It was all right.
33%.
It was okay.
Control said it was good.
It was so good.
Control
All right,
liked it.
cool. All right. Well, we'll wrap it there. That was the hash for this week, actually. It's Friday, so now you can go have a weekend, and we hope you have a good one. I'm Zach Seward. We got George Glutis today. We got Jen Sanasi. We got Will Foxley. We're back again on Monday. All right. You go have a good one now. All right.
See ya.
Bye.